speaking about asset allocations, we see higher correlations worldwide. Do you think it's still useful to spread over asset classes?
Absolutely. If you look at the returns of the different markets, one of the interesting things that you will see is that despite the high correlations, there are big differences between the returns of the best performing market and the worst performing market. And those dispersions in returns are very good reasons to continue to diversify a portfolio, to continue to look for returns away from home bias. And correlation describes only one aspect of returns. It's just how returns move in a period of shock. But the dispersion in returns between markets exist, and I think it's still a very good reason to continue to diversify portfolios.
Over the past years, we saw a lot of influence from the quantitative easing, especially in the US. Do you expect it will be dominant for the next few years, also for Europe?
I think so. We believe that there's a very good chance that the European Central Bank will announce quantitative easing potentially in a couple of days, and a worst case scenario maybe a little bit later. But quantitative easing is likely to come to Europe. Remember, at the same time, quantitative easing in Japan started several months ago, maybe a year ago, excuse me, and is likely to continue. So we are still in a world where quantitative easing is a dominant force, maybe not in the US, but in Europe it is. And based on what we have seen in the US equity market, quantitative easing can have a very positive effect. On one hand, it has helped a lot of banks, a lot of institutions improve the quality of the assets on their balance sheet by securitizing assets and moving them away. It has also helped provide confidence to the market by increasing the appetite for risk, and we think those same effects will also happen in Europe and will help European equity markets in the coming year.
Okay. You were quite optimistic about the European equity markets, but you are quite negative about the euro. Can you explain that?
Well, in the case of the euro, we think quantitative easing is going to be a big reason why the euro will continue to stay weak in 2015. You add to that, obviously, the fact that in Europe you pay to deposits assets at the ECB, while in other parts of the world you get paid for deposits. So those are pretty negative things that will continue to push the euro down. And a weaker euro, among other things, right, such as the quantitative easing itself and improving outlook in Europe, will continue to help European equities. One way, through improving competitiveness of European companies, helping them increase their market share, increase their exports, and also their earnings from overseas will be translated into more euros with the weaker euro exchange rates. So I think the two are consistent. Weaker euro will help the eurozone and will help European equities.
Do you expect the euro to be one-on-one with the US dollar?
You know, it's hard to tell exactly what level we will see the euro at, but we're definitely expecting and we're implementing in our portfolio a position that would benefit from euro staying weak and getting further lower in 2015. Whether we reach parity or not in 2015 is an open question, but we're definitely expecting weakness in this coming year.